Hello class, welcome to chapter 11 on capital budgeting and investment analysis. So I already covered the first part of this chapter, which is in a different video, chapter 1, part 1, and that's where I gave the overview of the time value of money. That's a very basic and fundamental concept. So if you're still confused about present value of annuity, discounting, um, compounding, please watch part 1 of chapter 11 video first. So in this video, which is part 2 of chapter 11, I will actually go over the capital budgeting process and pretty much 4 methods we're going to use. 4 methods. Okay, so let me skip time value of money and get to capital budgeting. Here we go. So in this chapter, we're talking about making long-term decisions. If you remember chapter 10, there we focused on how to implement short-term managerial decisions, whether or not to accept additional business and whether to get rid of a division or a segment of business, whether we should produce a part internally or outsource it, buy it from somebody else, and so on and so forth. There were 7 types of short-term decisions. In this chapter, we're talking about long-term decisions, the acquisition of long-term assets, the ones that require large sums of money and the ones that we will be using for a long period of time. So the main goal of this chapter is to figure out how an investment, how a purchase of a piece of equipment, for example, or a truck or any kind of long-term asset how can it earn satisfactory return on investment. And these are long-term decisions, so they're some of the most important decisions and riskiest decisions that managers make. So we need to implement careful analysis, and these are types of risks which are included in the process of capital budgeting. We don't know the outcome, we involve future, the commitment could be really long-term, many years, we have to spend a lot of money upfront, and in the future we might not be able to reverse the decision we made. So the chapter covers 4 different methods of capital budgeting analysis. The first 2 methods ignore time value of money. They're very easy methods, and they're usually used to just make kind of a dirty decision, kind of a rough decision. And these could be used for investments with a shorter lifespan. So the first one is called Payback Period, PBP, and the second one is called the accounting rate of return. The third and the fourth methods are they consider time value of money. We will be using the present value of annuity. We will be using the tables. These are more difficult to calculate. They're used for investments with longer period of life, and it's the net present of value, or NPV, and it's the internal rate of return, or the IRR. So let's talk about the payback period first. So pretty much here we're interested in how long will it take us to recover the cost of our capital investment, the purchase price, right? So we look at the net annual cash flows that the investment will produce. I buy a piece of equipment. What additional cash flows every year will that piece of equipment give me? And we ignore time value of money. So this is a simple formula. My cost of investment, how much I purchase an asset for, divided by annual net cash flows. Not net income. We're focusing here on the actual cash flows, right? And in general, if I have a choice, I would like any kind of investment, any kind of project that has a shorter payback period. How many years and months will it take me to recuperate my original investment? So this is an example of how to calculate payback period with even cash flow. So every year the cash flow is the same. So here we are a shipping company. We're considering buying a new machine. This is the cost of the machine, $130,000. This is the number of years. There is no salvage value. If there is a salvage value, it's considered to be an additional net cash flow at the end of life. And here we estimate that cash inflows from customers will be $200,000. And then we also look here at the cash outflows for operating costs is $176,000. So the difference is $24,000, right? So to operate this machinery, we have to spend $176K per year, but we're gonna have more sales, and so that's an additional $200,000. So the positive inflow is the difference, which is $24,000. We don't have to worry about the annual net income here, which is really going to be net annual cash flow minus depreciation. And you can calculate depreciation here. I will need to worry about the annual net income for the next method, for the ARR, accounting rate of return. But here I just focus on the cash flows, right? So cost of investment, I'm spending $130,000 divided by annual net cash flow, $24,000. So it will take me 5.42 years. I am planning to use this machine for 10 years. So in less than 5.5 years, the cost will be recuperated. So my payback period is shorter than life of this machine. So it's a good decision. I should buy this machine if I'm using this method. Now, what if I have uneven cash flows? It gets a little bit more complicated if every year the cash flow is different. Let's look at the example. So Bay Hardware is adding a product line that requires an investment of $1,450,000. So this is cash outflow. I have to spend this money. And then managers estimate that this investment will have total of 8 years life, 8 years. So here's year 0. So just don't rush here, use this method. There are a couple of different methods, but just take your time to figure out when you pretty much break even, right? And for the first year, the net cash flow is $305,000. So negative $1,450,000. First year, this product line will make me $305,000. So my cumulative net cash flow decreases. And then for the second year, it will make me $290,000. So negative plus positives gives me a cumulative net cash flow. So I want to see when this net cash flow becomes 0. And then it will give me $255,000 each year thereafter for 6 years. So when I do the calculation, I see that my net cash flow is still negative in year 5. It becomes positive in year 6. So 5-point-something years will take me to pay back for this investment. So we need to figure out that decimal, right? And this is what we do. So I'm still missing $90,000, right? After 5 years, I'm still short of $90,000. We're receiving $255,000 in year 6. So the way we're going to calculate the decimal, I know it's going to be 5 years plus the decimal. I'm simply going to take 90,000 I have to recuperate, divide by 255, which gives me 0.35. So this is a calculation you will have to make in some of your homework problems and on the test. So the payback period here is 5.35 years, which is acceptable since I'm going to use this investment for 8 years. I do want to say that there are 2 strengths to this method. We use cash flows, not income, not net income, the actual cash that will be coming in. And it's very easy to use, so managers often use it as an initial screening tool. And if it looks like a good decision, then they go on to more complicated methods, such as net present value. Now, there are major weaknesses because we ignore all cash flows that happen after the investment is paid for. So I might be making a wrong decision if I'm looking at two different projects, two different investments, and I just look at the time when it recuperates the costs. Well, what happens after that? This method ignores time value of money. As you will see, 255,000 from 5 years from now is not really worth 255,000, right? I have to spend 1,450,000 today, but I'm then counting all these future cash inflows in the present value terms, which is wrong. And also, it ignores profitability, right? Like if two projects have the same payback period, however, the life for project A is twice longer, then project A should be preferred over project B, but the payback period does not show it to me. So the second method we're going to use, which also ignores time value of money, is called ARR, the accounting rate of return. We kind of talked about it in financial accounting in the way we look at the actual return over the asset's life, right? Pretty much we're going to take annual net income and we're going to divide it by by the annual average investment. So how much money we spent, annual average investment, versus how much net income that asset will earn me. This method is the only one that is using net income instead of net cash flow. And net income is used by GAAP, by the accrual accounting method. Therefore, we use the word accounting rate of return because it's using net income, which is preferred by GAAP over cash. So again, this is the formula. So pretty much net income after taxes divided by annual average investment. Different textbooks give different formulas for annual average investment. This is how we're going to calculate it. The beginning book value plus ending book value divided by 2. So that will be the calculation. The beginning book value plus ending book value divided by 2. So when we compare investments with similar lives and risks, we will prefer the project or investment with the higher ARR. So similar example that we used for payback period, but now we will have to consider depreciation. Well, not really. Look here. So what we're going to do, we have the average net income. And again, how I calculated it, if you look at the depreciation, right? We take 130,000. There is no salvage value, cost minus salvage value, divided by 10 years. It means that the depreciation for this machinery will be $13,000. My net annual cash flow is 24K minus depreciation. Remember, depreciation is a non-cash expense, right? So I need to subtract it if I want to know net income, but it's not the actual cash outflow, so it's added back in for when we need to figure out cash flow. We actually will be doing it in the next and last chapter on the statement of cash flow. So 24,000 minus 13,000 gives you the net income, if it wasn't given, $11,000. And then we need to divide net income to the annual average investment. Remember the formula, beginning book value. Beginning book value is cost. In general, guys, book value is cost minus accumulated depreciation. But in the beginning, we don't have any accumulated depreciation. And the ending book value is always equal to salvage value. So you can think right here, this ending book value, it's always, right? It's always the same as salvage value. If salvage value is 0, then ending book value is 0. So it's pretty much beginning book value, which is 130,000 divided by 2. So this is my average annual investment, and so the percent is 16.9. So is it good or is it bad? Usually the business will have a required rate of return. It will be given to you. So these are some of the quick studies that are good to look at. The required rate of return is usually the cost of capital, right? So the business has all these different loans, and what's the average interest the business is paying on these loans? Let's say it's 10%. So whatever investment the business makes, it uses partially or fully money that we borrow from the bank and we're paying on them, that 10%. So anything above this required rate of return cost of capital would be acceptable. This is way higher, right? And the higher the better. So this investment looks like a good investment. Again, there are advantages and disadvantages. These are some of the major weaknesses of ARR. Now we're moving to the last two methods, which actually are better methods because they do look into the time value of money. And this is one of the most widely used methods called NPV, net present value. So net present value analysis applies the time value of money to future cash inflows. It brings future values of cash into the present value amounts and cash outflows. So the management can evaluate the project's benefits and costs at the current time. So this is how we calculate NPV. We discount future cash flows, a year from now, 2 years from now, 3 years from now, all these different cash flows. Now, it will be different if my cash flows are equal every year. It will be easier to make a calculation versus if they're unequal. I have to discount all of them. And we are using tables that I described in part 1 of the video, present value of a dollar table and or present value of a dollar annuity. And for the rate, for the interest rate, you will be given this required rate of return. I mentioned that rate. It's also called hurdle rate sometimes. It's typically the cost of capital, right? It's what is the rate the company must pay to its long-term creditors and shareholders? What's the average interest at which the company borrows? It will be always given to you, or sometimes you would be able to figure it out when we are doing with you the last method, internal rate of return. And then, guys, we subtract the initial amount invested, which is today, present value, minus the sum of the discounted cash flows. If NPV is more than 0, it's a good decision to make. If the NPV is negative, net present value is negative, do not make that decision. So it should be, the higher it is, higher from 0, the better it is. So if we have equal cash flows from the investment, you think about this investment as an annuity. Annuity is any kind of investment that either we receive or we pay, where your cash payments or cash receipts are the same every year or every period. A pension is an annuity, right? Your mortgage payment or a car loan payment is an annuity. So fast track is considering the purchase of a machine where we have to spend today $16,000. For 8 years, it has 8 years useful life, 0 salvage value. Again, if we have a salvage value in any problem, if we have the actual salvage value, it's the money we're gonna get at the end of the 8th year. So if the salvage value is 1,000, it's an additional 1,000 that will come to us, and we have to discount it to today. So this investment promises to pay annual net cash flows of $4,100 every year the same amount, equal cash flows. And the required rate of return is 12%. That's that rate, hurdle rate, which is given. Your textbook says, well, discount every net cash flow, right? They take present value of a dollar right here from the tables. I talked about the tables. You can use the tables at the end of your book. This is table B1, or you can use financial calculator, or you can use online TVM calculator. So they do discount every cash flow. So this $4,100 a year from now, today is worth $36.61, and $41 2 years from now, of course, is worth less today. Another way to think about it, if I invest $3,269 at 12% for 2 years, I will get in 2 years $4,100. And so we discount all of these cash payments, and then we get the total. And then we subtract the initial investment, which is in today's dollars. And my net present value is positive. Now, it's much faster, instead of doing it per year, just to do, right here, simplified, calculate present value of annuity. So instead of looking at table B1, look up the present value of annuity factor in table B3. This is 8 years, so my number of periods is A. My interest percent given, 12%. This is the present value of annuity factor. It's in the table. Again, if you go to the table, you'll find it. Multiply it by that annual cash flow, and you get the amount, 20,367. Much faster, one calculation instead of 8 calculations. Minus the initial investment, we see that NPV is positive. I pay in 16,000, I get out of this investment 20,367. So discount it and then subtract the initial amount investment from the sum of the discounted cash flows. So this is how NPV works, pretty much. If net present value is more than 0, make that investment. If it's less than 0, oh, where did it go? If my NPV is negative, do not invest. When I compare several investment opportunities of similar cost and risk, we prefer the one with the highest positive NPV. So these are different decisions. You can look at them, different practice. I'm not going to go over them. And guys, if I have uneven cash flows, so right here are even, right here investment B uneven, and C uneven, I have to discount each cash flow separately, look up in table B1. But when I look again at which project is better, is it A or is it B or is it C, the best one is B. It gives me the highest net present value. A is acceptable to, C is not. It will lose me money. So there are a couple of other complications of NPV. As I mentioned, if salvage value is not 0, that's an additional net cash flow, and we need to discount it to present value. Also, if we have depreciation, we need to convert net income sometimes to cash flow by adding it back in. So some of your homework problems, if they give you depreciation, remember, in net income, you are not interested in net income here. You're interested in net cash flows, so depreciation has to be added back in. Now, another way to look here at decision making would be so-called profitability index, and it's the present value of net cash flows divided by investment, and it's an index, profitability index. We're using the same amounts, so I have project 1, the present value of all net cash flows. So not net present value, but the actual, like this amount, these totals. I'm using these totals. When you discount all net cash flows and then you add them together. So it's $900,000. This is the investment, how much we have to pay today, pretty much how much we have to spend today. And you just divide A, divide by B, and you look at the index. And this index is, if it's higher than 1, it means that the project is acceptable. It pretty much means that NPV is positive. If the project is less than 1, if the profitability index is less than 1, that means that NPV is negative, not a good project. And we're always going to choose an investment with the highest profitability index. So right here, project number 2 will be picked, will be chosen because its profitability index is 1.5. Okay, and the last method is the IRR, so-called internal rate of return. It relates to NPV. The idea here is that we want to find out what's the interest rate at which my NPV is break-even. What is the interest rate that makes the NPV of my investment to be 0? And there are 2 steps. We have to do some guessing here. It's not as a specific one. It's good here to use a financial calculator, but we have to use tables sometimes. So 2 steps. Compute the present value of annuity factor. So you will be given cost of investment and you will be given the annual net cash flow. I think here for this method we will assume all our net cash flows are equal. So you take the cost of the investment divided by annual net cash flow. That gives you the PV, present value of annuity factor. And then we go to table B3, present value of annuity table, and we look up that factor. And we use trial and error, and we figure out what the rate is using the tables. And in general, after that, if my internal rate of return is higher than that required rate of return, we talked about it, that hurdle rate, that cost of capital, then we accept the investment. If my IRR is lower, it means I will be losing money and we reject the investment. So here's the example. We have a project with even cash flows, right? Again, if it's uneven, it gets more complicated. You can use Excel, that's higher level courses. Project life is 3 years. Initial cost of investment is $12,000. My annual net cash flow is $5,000 every year. Determine the IRR. Number one, step one, compute the present value of annuity factor. Take your initial investment, again, this is the formula right here, cost of investment divided by annual net cash flow. By the way, that is pretty much the formula that we used for the ARR too, accounting rate of return. Okay, so $12,000 divided by 5,000 per year gives me 2.4. That's present value of annuity. You go to table B3 and right there, you look for it. So 2.4, what's the closest amount? It's right here, 2.4. It's 3 years, right? So you use your periods 3 years. So what's the closest rate? It's 12%. So we're saying IRR is approximately 12%. Then what? Then we have to look at the company's required rate of return or hurdle rate. So it's not given here, but usually in the problem they will say, if the company's hurdle rate is 10%, this is a good investment because my IRR is higher. If your required rate of return or hurdle rate is higher than IRR, that's not a good investment. So look at these two steps. And again, as I mentioned here, for uneven cash flows, we have to use either a financial calculator or a spreadsheet. Okay, here's an example. Use the NPV method to determine whether Old West products should invest in the following projects. Project A costs $290,000 divided by 7 annual net cash inflows of $63,000. And this company has a required rate, which is hurdle rate, is 14%. So we pretty much just take 290,000 divide by 63,000, we get 4.603, and then we're gonna look up, let me show you actually, I'm going to go to your textbook here. I should have opened it earlier, but it's okay. So 1B, let's go to your project, to your textbook. And guys, so the tables are at the end of the book. I think it's Appendix B. So page B-10, but we need table B3, present value of annuity. Here you go. Page B-11. In this example, we're looking for 7 periods, 4.6. So 7 periods, 4.6, right here. Right here. It's not 12%, it's not 10%, it's somewhere in between. It's trial and error, right? So it's somewhere between 10 and 12%. And that's what I said. But my required rate of return is 14%. So my IRR is lower, so I'm going to reject it. And guys, the second example, we have a project B. Again, we take the investment, divide by annual net cash flow. It's 10 years, 5.563. So if 10 years, 5.563, 10 periods, 5.563. It's between 12 and 15 or 14. So my IRR is between 12 and 14%. My required rate of return is 10. IRR is higher, so we will accept this offer. Again, guys, I want to summarize that in this chapter, we looked with you at 4 different methods of capital budgeting analysis, long-term decisions. The first 2 methods, they ignore time value of money, so they were short and easy, but not perfect. The payback period and the accounting rate of return. The third and fourth method were a little bit more difficult to calculate. We had to use present value tables. They consider the time value of money, and the names of these methods are the net present value method and the internal rate of return. Thank you so much.